What if I told you there's a way to make up to $500,000 in real estate profits and legally pay zero in capital gains taxes? And it has nothing to do with real estate professional status, short-term rentals, or cost segregation. In fact, most investors already have access to this strategy. They're just not using it strategically. And it comes down to this: using your primary residence as an investment tool, not just a place to live. Because when you understand how to do that intentionally, it can become one of the most powerful ways to build and redeploy tax-free wealth. And in this video, I'm going to show you exactly how. If we haven't met before, I'm Kenji from Semi-Retired MD. I've been investing in real estate for over 25 years, and my wife Leti and I have built a portfolio of over 185 rental units. And we also own an additional 2,400 syndicated doors. We've also helped over 4,500 high-income earners learn how to use real estate to build wealth and reduce their taxes. And one of the things we're always looking for is creative ways to build wealth through real estate. This is definitely one of those strategies that should be part of every investor's toolkit. The problem is, it's underutilized, and that's exactly what we're hoping to change with this video. Now, this is especially important if you're a high-income earner, because one of the biggest challenges you have at higher income levels is you're earning more, but you're also paying a higher percentage of that income in taxes, and it becomes harder to find ways to keep more of what you make. And the higher your income goes, the fewer strategies there are that meaningfully reduce your tax bill. That's why real estate is so powerful. It's one of the few areas where you can actually shelter meaningful amounts of income or gains. And more importantly, you can use it strategically, so you have more control over how and when you're taxed. And one of the most underutilized ways to do this is through the primary home exclusion, because this is one of the rare situations where you can take appreciation and turn it into completely tax-free gains. That almost never happens anywhere else. So let's break down exactly how this works, starting with the basic rules behind the primary home exclusion. This is a rule in the tax code, section 121, that allows you to exclude a significant portion or all of your gains when you sell your primary residence. If you're single, you can exclude up to $250,000 in capital gains. If you're married and filing jointly, that number goes up to $500,000. Now think about that. That means you could buy a property, live in it, and later sell it and walk away with up to $500,000 in profit without paying capital gains tax. Now there are a couple rules you need to follow. The main one is what's called the 2 out of 5 year rule. You need to have owned the property for at least 2 years and lived in it as your primary residence for at least 2 of the last 5 years before you sell. And here's where it starts to get interesting. Those 2 years don't have to be consecutive, which gives you flexibility in how you use the property over time. And that flexibility is exactly what allows investors to start using this strategically instead of just passively. Because once you understand this, your primary home stops being just a place you live and starts becoming a tool. Let me show you what that looks like. Now here's the shift that most investors never make. Most people think of their primary residence purely as a lifestyle decision. It's where you live, where your family is, and it's separate from your investing. But once you understand how the primary home exclusion works, you can start getting creative and use it as a tool to build wealth. You can turn it into an asset that can generate tax-free gains. And that gives you a level of flexibility that most other investments don't. When you move, how long you stay, and when you sell, those decisions aren't just personal anymore. They become part of your overall investing strategy. Because instead of this being a one-time benefit, you can use it multiple times to build and redeploy tax-free capital. Let's start with one of the most common ways investors use this strategy. You buy a home, you live in it for a few years, and then at some point you move. Maybe it's for a new job, a better opportunity, or a change in lifestyle. Instead of selling the property, you decide to keep it and turn it into a rental. This is actually how a lot of investors become accidental landlords, especially for physicians where you might move multiple times early in your career. You buy during residency or fellowship, then move for your attending job. And now you're left with a decision. Do you sell or do you keep it? From a wealth building perspective, keeping it often makes sense. You already own the property, you're familiar with it, and now it becomes an income producing asset while continuing to appreciate over time. But here's where the strategy comes in. Once you move out, that 5-year window we talked about earlier starts to work against you. You now have about a 3-year window where you can still sell the property and qualify for the primary home exclusion. If you sell within that window, you can still access up to $500,000 in tax-free gains. But if you hold the property as a rental for too long and fall outside of that window, you lose the ability to use the exclusion. And now that gain becomes fully taxable. So this becomes a strategic decision. Are you planning to hold long-term for cash flow and appreciation? Or are you planning to sell within that window to harvest that tax-free gain? Another answer here is right or wrong, but the key is being intentional about it. Now, before you decide to rent, there's one more thing to consider, something that most people miss. Once the property becomes a rental, you'll likely start taking depreciation, which helps reduce your taxable income while you own it. But when you sell, that depreciation gets recaptured and taxed. So even if you qualify for the exclusion, that portion is still taxable. Now, if you're not planning for it, that can become a very unwelcome surprise. Even with depreciation recapture, this is one of the most powerful strategies available to real estate investors because you're combining appreciation, rental income, and potentially a large tax-free gain all within the same property. Because now you're not just thinking about this property as a rental, you're thinking about timing, exit, strategy, and how this property fits into your overall plan. Now let's look at the reverse strategy. You already own a rental property and it's appreciated significantly. And you start thinking, what if I just move into this property for a couple years and then sell it tax-free? On the surface, that sounds like a great strategy, and you'll hear real estate gurus talking about it a lot on social media. But here's where the rules catch most people off guard. Because moving into the property doesn't automatically make the entire gain tax-free. The IRS looks at how the property was used over the entire period of ownership. Time spent as a rental is considered non-qualified use, and that portion of the gain does not qualify for the exclusion. So instead of the entire gain being excluded, it gets prorated. Part qualifies, part doesn't. Let's say you owned a property for 10 years, 7 years as a rental, and 3 years as your primary residence. Only a portion of that gain is eligible for the exclusion. The rest still gets hit with capital gains taxes. And any depreciation you took while it was a rental will still be recaptured and taxed when you sell. So this isn't a simple move in for 2 years and eliminate taxes strategy, but that doesn't mean it's not useful. Because even a partial reduction in taxes can have a significant impact, particularly on larger gains. And in some cases, it also aligns with where you are in life. Maybe you want to relocate, simplify, or reposition your portfolio. So again, know the tax consequences before you move, understanding how much of the gain will qualify, and making sure the move makes sense both financially and personally. Now let's talk about one of the most creative ways to use the primary home exclusion. This is often referred to as the live-in flip. The idea is simple. You buy a property that has upside, you move into it, you improve it over time, and then you sell it after meeting the 2-year requirement. What makes this powerful is how the gains are treated. In a traditional flip, where you buy, renovate, and sell quickly, those profits are typically taxed as ordinary income. And for high-income earners, that's adding income to your already high income, and all of it is being taxed at the highest rate. But with a live-in flip, because you're living in the property, you may be able to capture those gains under the primary home exclusion, which means some or all of that gain could be tax-free. Now let me show you what this looks like in practice. We had a doctor in our community who did this early in her career with a duplex. She lived in one unit and rented out the other. And while she was living there, she improved the property. There was no pressure to rush the renovation. She could take her time, make thoughtful upgrades, and increase the value of the property steadily. And she also rented out extra space to offset her costs even further. So let's break down what's actually happening. She's lowering her expenses, increasing the value of the asset, and positioning herself for a potential tax-free gain when she sells. That's a fundamentally different outcome than a traditional flip. It's slower, more deliberate, and it aligns with your lifestyle instead of working against it. But there's one thing you have to get right. The IRS looks at intent. If your activity starts to look like a business where you're repeatedly buying, renovating, and selling properties, you could be classified as a dealer. And if that happens, your gains are taxed as ordinary income, and the primary home exclusion may not apply. So this strategy works best when it aligns with how you're living, not when it's purely transactional. But when done thoughtfully, this can be one of the most powerful ways to combine lifestyle, investing, and tax strategy into a single move. When you step back and look at all of this, the primary home exclusion is not just a tax rule. It's a strategic tool that gives you flexibility in how you build and access your wealth through real estate. Whether you're turning a primary residence into a rental, moving into a property to reduce your tax burden, or using a live-in flip to generate tax-free gains, each of these strategies gives you a new lens for how you think about your portfolio. And over time, that's what really makes the difference. Because you're not just relying on appreciation or cash flow. You're also using the tax code to your advantage to create and redeploy capital more efficiently. And when you start stacking those decisions across multiple properties in multiple years, that's when you start to see acceleration. So the goal here isn't just to understand this rule, it's to start thinking differently about how your primary residence fits into your overall investing strategy. Because for most high-income earners, this is an opportunity that's sitting right in front of them. They're just not using it. And if you want help thinking through how to apply strategies like this to your specific situation, that's exactly what we do. And if you're interested, you could book a free call with our team, where we'll walk you through your goals, your current situation, and help you map out a strategy that makes sense for you. We'll also show you how strategies like this fit together with things like bonus depreciation and real estate professional status, so you can start building a plan that actually reduces your tax burden over time. You can find the link to book a call in the description below. Thanks for watching. We'll see you in the next video.